Your parents bought a house on a regular salary, a teacher, a truck driver, a factory worker. They saved up, signed the papers, and moved in. That was normal. Now you make more money than they did, and you still can't afford a house. The average home in America costs $420,000, and every year that number climbs higher. You're not bad with money. Something else is going on, and once you see what's actually driving these prices up, you'll understand why the system was never designed for you to win. Back in 1990, the median home price in America was around $80,000. The median household income was about $30,000. That means a house costs roughly 2.7 times what a family earned in a year. Stretch forward to the year 2000. Homes were around $120,000. Income had risen to about $42,000. That's still under 3 times annual income. Tight but doable. Now look at today. The median home price is over $420,000. Median household income sits around $75,000. That's 5.6 times your annual earnings. The ratio almost doubled. You didn't get lazier. You didn't suddenly become irresponsible. The math just stopped working, and nobody in power is in a rush to fix it because the people who already own homes are watching their value go up every single year. The system rewards people who got in early, and it punishes everyone trying to get in now. There are 3 major forces pushing home prices beyond your reach, and none of them have anything to do with your spending habits. Force number 1, corporate buyers. In 2021, investment firms bought roughly 1 in 4 single-family homes sold in major cities. According to a report from the National Association of Realtors, institutional investors accounted for about 28% of all home purchases that year. These aren't families. These are billion-dollar companies buying up entire neighborhoods. They turn houses into rentals. They bid above asking price with cash, and they push regular buyers like you right out of the market. Force number 2, we stop building enough homes. The National Association of Home Builders estimates the U.S. is short by roughly 4 million housing units. Zoning laws in most cities make it illegal to build smaller, affordable homes. In many neighborhoods, you literally cannot build a duplex. Only single-family houses are allowed. That keeps supply tight, and tight supply means higher prices. Force number 3, builders only want to build expensive homes. When a construction company has a choice between building a $200,000 starter home or a $600,000 luxury home, they pick the luxury home every time. The profit margin is bigger, so even when new homes go up, they aren't built for you. They're built for people who already have money. These 3 forces, corporate buying, limited supply, and luxury-focused building, stack on top of each other. And you're at the bottom of that stack. Now let's run the real numbers, because once you see this breakdown, you'll understand exactly why it feels impossible. Say you earn the median household income. That's about $75,000 a year. After taxes, you take home roughly $58,000. That's about $4,800 a month. Now let's price a median home, $420,000. You put down 5% because that's what most first-time buyers actually do. That's a $21,000 down payment. Your mortgage is now $399,000. At a 7% interest rate, which is close to where rates have been sitting, your monthly payment comes to about $2,650. That includes principal and interest only. Add property taxes. In most states, that's another $350 a month. Homeowners insurance adds roughly $150. Some areas require private mortgage insurance because you put down less than 20%. That's another $200. Your total monthly housing costs, $3,350. Remember, you bring home $4,800 a month. $3,350 goes to the house. That leaves you $1,450 for everything else. Food, transportation, utilities, phone, internet, student loans, health insurance, childcare if you have kids. $1,450 for all of it. That is 70% of your take-home pay going to housing. The standard guideline says you should spend no more than 28% of your gross income on housing. You're at 70% of net. Since 2020, the median U.S. home price jumped from $296,000 to over $420,000, a 42% increase. In that same period, median wages only grew about 20%. The gap between what you earn and what a home costs is the widest it has been in over 40 years. You're not bad with money. The math literally does not work anymore. And every month you wait, the gap gets wider because prices keep climbing while your paycheck barely moves. Here's what nobody talks about. High home prices don't hurt everyone. They hurt you, but they make a lot of powerful people very rich. Start with the banks. When a home costs $420,000 instead of $250,000, you borrow more. A bigger loan means more interest paid over 30 years. On a $399,000 mortgage at 7%, you'll pay roughly $556,000 in interest alone. The bank makes more than the house is worth, just in interest. Now look at local governments. Property taxes are based on home values. When prices go up, tax revenue goes up. Cities have zero incentive to make housing cheaper. That would mean less money for their budgets. Then there are the homeowners who already got in. According to the Federal Reserve, American homeowners gained over $9 trillion in home equity between 2020 and 2023. Every time your potential home gets more expensive, someone who already owns one gets richer. And landlords, if you can't buy, you rent. The average rent in America is now over $1,700 a month. Landlords know you have no other option, so they raise the price. The entire system, banks, cities, existing homeowners, and landlords benefits when housing stays expensive. You are not the customer this system was built for. You're the fuel that keeps it running. Your rent payments, your mortgage interest, your desperation to get in, that's what powers the machine. The objection you hear most is, just move somewhere cheaper. And on the surface, that sounds reasonable. Housing in some Midwest and Southern cities still sits under $250,000. But here's the catch. Those cheaper cities often have lower paying jobs. If you earn $75,000 in a major metro and move to a city where the same role pays $50,000, you didn't save money. You just traded one trap for another. According to Harvard's Joint Center for Housing Studies, housing is considered unaffordable in 80% of U.S. counties for the average worker. Moving doesn't solve the problem. It just relocates it. So what can you actually do? Step 1. Look into first-time homebuyer programs in your state. Almost every state offers down payment assistance. Some cover $10,000 to $25,000 of your down payment. Most people never apply because they don't know these programs exist. Step 2. Consider house hacking. That means buying a small multifamily property, a duplex or triplex, living in one unit and renting the others. The rental income covers most or all of your mortgage. You live almost free while building equity. FHA loans let you do this with as little as 3.5% down. Step 3. Extend your timeline and stack cash aggressively. If you save $800 a month for 3 years, that's $28,800. Combine that with a state assistance program, and you could have $40,000 or more for a down payment. The system is stacked against you. That's real. But there are cracks in the wall. And those cracks are your way in. 2 people, both earning $75,000 a year, both renting at $1,700 a month, both told they can't afford a house right now. Person A accepts it. They keep renting. They don't research assistance programs. They don't change their savings habits. Every year, rent goes up 5%. After 5 years, person A is paying $2,170 a month in rent. Over that entire 5 years, they spent $113,000 on rent. They own nothing, no equity, No asset. That money is gone. Person B takes a different path. They find a state down payment assistance program worth $15,000. They save $800 a month for 2 years. That's $19,200 in savings. Combined with the assistance, they have $34,200 for a down payment. They buy a duplex for $310,000 using an FHA loan. They live in one unit and rent the other for $1,400 a month. Their mortgage payment is $2,200. Minus the rental income, they pay $800 out of pocket. That's less than half what person A pays in rent. After 5 years, person B has paid down roughly $30,000 in principal. Their property appreciated about 15%, adding another $46,500 in value. Person B's total equity position over $76,000. Person A has $0 in housing wealth. Person B has over $76,000. Same paycheck, same starting point. The only difference is what person B learned. And when they decided to act, this is not your fault. The system was built before you got here. The rules were written by people who already owned the houses. But now you see the game. You see who profits. You see why the math stopped working. And you know the moves that still exist. You're not someone who just watches prices climb anymore. You're someone who understands why and what to do about it. Nobody taught us this about money, so let's keep talking about it.